To start the year, stocks soared to record-breaking highs and then collapsed, plummeting 11% in 8 trading days. The market had climbed back by March 9th when President Trump slapped $50 billion of tariffs on China and triggered fears of a trade war, which sparked another stock sell-off. If you're a bit weary from the turbulent ride, here are the most important facts to stay focused on. On March 22nd, President Trump signed a memorandum officially targeting China's economic aggression and proposing $50 billion in tariffs on Chinese imports into the United States. China responded within days by imposing tariffs on the United States. On April 5th, the president added another $100 billion of proposed new tariffs on Chinese goods, triggering another sharp sell-off in the market. These actions followed an investigation by the U.S. Trade Representative, initiated at the request of President Trump on August 18, 2017, under Section 301 of the Trade Act of 1974, into the government of China's acts, policies, and practices related to technology transfer, intellectual property, and innovation. In the 215-page report summarizing the findings of the investigation, U.S. Trade Representative Robert Lighthizer called out the world's second-largest economy for requiring joint ventures, restricting foreign investment, and imposing administrative reviews or licensing requirements that force technology transfers from American companies. The report also cited Chinese government plots to steal valuable business information from the U.S. that have resulted in criminal convictions. While China has earned its reputation for unfair trade activities and the risk of a trade war between the world's two largest economies has increased, the president's position is looked upon as a negotiating tactic, and it could stir a coalition of U.S. trade partners to act against China in unison. When he signed the Section 301 action targeting China, the president said he believed talks with China will end with a deal. The back-to-back spikes and dips started when stock valuations exceeded the upper band of their normal range. Measured by the S&P 500, shares in large U.S. companies historically averaged a price between 17 to 19 times their trailing 12-month earnings. In the euphoria that followed the signing of the tax law, the price of the S&P 500, in soaring past its usual upper range, became ripe for a fall. With prices lower, stocks have fallen back within their normal range based on earnings expected for 2018 and 2019. Over the 10-year period ended March 31st, the S&P 500 Total Return Index has gained 148%, more than doubling. From the financial crisis market bottom on March 9, 2009, the S&P 500 Total Return Index gained 372%, nearly quintupling. Expectations for 2018 earnings growth is nearly triple the norm. At 2,600, the Standard & Poor's is fairly priced, and the economy, by historical measures, is booming. Expect more plunges on frightening headlines. It's the price you must pay to achieve the risk premium historically earned on stocks.